So you just bought a house in and around the Chesapeake Bay tributary. Hopefully your yard's cleaner than this. Careful with your trash around these parts. Remember the teachings of Pennywise. We all float down here. And you're wondering if your mortgage needs to be protected in some way, and you're hearing about PMI versus mortgage redemption insurance. I'm gonna try to clear things up for you while I clear up this beachhead. PMI, also known as private mortgage insurance, is insurance that you have to pay for when you do an unconventional loan, and you pay for it to protect the lender. So in case the lender ever has to foreclose on your home, that could be because payments stopped due to your death, and the lender attempts to recoup their money by foreclosing on the home, PMI pays for the difference to satisfy the loan balance that they don't receive out of that transaction. Your family, however, gets nothing, and so in steps in the idea of mortgage redemption insurance, which quite honestly is just a marketing technique for life insurance. Mortgage redemption insurance is term life insurance. Please do not be fooled by thinking you're getting something special. Now, back in the day, like 80s and 90s day, mortgage insurance was actually kind of a special type of policy. These were what were known as decreasing term life insurance policies. So the amount of insurance chosen reflects the amount left to pay on the mortgage, and the time chosen to pay it off reflects the length of the mortgage note. And as you would pay on your mortgage, the term policy itself would decrease in value every year. And it was supposed to hit zero in the year that you paid off your house. But decreasing term insurance had its issues, like for one, you were paying the same price no matter how much coverage you had. So in the first year, you're paying the same premium as you were in the 20th year, even though you had a fraction of the death benefit payable. And two, it didn't properly reflect the needs of a client. If you're a first-time new homeowner, you're probably also starting a new family and are slowly working your way up the income ladder. And so as you add on to your family and make more money, you're actually going to need more coverage, not less. So people were purchasing decreasing term insurance plans to cover their mortgage, but then later on having to purchase more insurance because they had a larger need. And this need actually could have all been satisfied at a younger, cheaper age with straight term life insurance. Straight term life insurance is when the premium and the death benefit never change. And these are the type of plans most insurers use now to cover large debts like mortgages.